The state of California is giving our home buyers 20% down. We all know as realtors, the biggest reason why people are not buying is they don't have the down payment saved. Many of our clients, many of us out there are able to afford the mortgage payment, but they're not able to purchase a property because they don't have money saved. This program gives you 20% down, and I've never seen anything like it. It's something that's not going to last. So pay attention, take notes. This is going to be recorded. It'll be posted on our YouTube page. So if you search The Collective Realty on YouTube, you can review it later. And Mardi, Kari, who is with Arcstone, who's a dear friend and one of the smartest people I know, is going to be talking to us about this program today. And he'll also be a resource for you after the seminar. So Mardi, take it away.
Hi, everyone. Thanks for having me. And I am really excited about talking to you guys about this California Housing Finance Agency product. I'm not sure if it's the caffeine that's making me super excited or if it's just the product itself, but it's exciting things to talk about, obviously. So I've had, 5 shots of espresso this morning, so bear with me. So I'm trying to keep up with Anthony and his energy. So he's got the natural energy, and I have to use the substance of caffeine to get there. But I wanted to just thank you, Anthony, for having me today. And it really is an exciting product because, as Anthony mentioned, the product hasn't really been publicized or been utilized in this level, where it was very streamlined. I mean, there are similar products where cities do individually, but this is California wide. So that's why we thought it would be a very appropriate time to bring this over to you guys, because not only is it's not limited to just certain counties and or cities. So without further ado, I want to jump in and get started because we have a limited amount of time and a limited amount of energy to focus on these things. So I'm going to share my screen if that's all right. Is that okay? All right, great. I am going to see. There we go. You guys would think that I would be a Zoom expert by now, but it still sometimes makes it very difficult. All right, can everybody see the screen? Maybe thumbs up. Yeah, okay, cool, awesome. Again, this presentation would not be obviously possible without Anthony. So thank you, Anthony, and the collective for making this available to the team and everybody that's joined. I just want to introduce myself. I'm Mardi Kari. I'm the president of Arcstone Financial. And our goal over here is to make homeownership possible. We're very passionate about our realtor partners. We take what you guys do very seriously because every time you go to work, you guys are creating an ecosystem. You guys are feeding an ecosystem of people like lenders, escrow officers, title reps, stagers, inspectors. So really, really grateful for all that you do for us, obviously, and we're here to support and service you guys. But with that said, want to start off with the actual product. We're going to talk about all these items on the agenda today. So want to start off with us, Arcstone Financial. We're local. We're a boutique mortgage banker in Los Feliz, California. And we're located at 1917 Hillhurst Avenue. So come by. We're right next door from Alcove. So I'm always really, really excited to meet our realtor partners in person. We've been in business for 23 years, since year 2000. And then our focus has been to bring diverse products that fit all sorts of borrowers to make their homeownership and wealth creation possible. And obviously we compete in the interest rate market. So to make sure that your clients are going to be able to get the best rates out there. You guys are wondering what CalHFA is. I'm just going to give you a quick introduction. CalHFA has nothing to do with FHA, which is part of HUD. CalHFA is a bond product or is a bond related product, but California has put together to make possible for people to buy homes without having to put money down. This product that we're going to talk about is one of many products that CalHFA has. And we won't bore you with the rest of them, but if you have any questions, let's talk about them because they make possibilities for people to buy homes not only not putting any money down, but also they'll cover the closing costs. So we've had situations where people have bought homes with like $4,000, $3,000 basically. So interesting products to talk about, especially in a market like this. I won't go too far into it, and we're going to send this presentation over to you guys if you guys want to understand who CalHFA is. You guys could read up on them, and we'll have the links to their website as well. Let's talk about this product. It's called the Dream for All Shared Appreciation product. So just remember, it's Dream for All. That's what they're calling it. It's a down payment assistance program for first-time home buyers. They have to be first-time home buyers. And we define first-time home buyers as that you have not owned any property in the last 3 years, and or you have not had your spouse own a property in the last 3 years, because California is a community property state. So they look at it as a collective effort. It's going to be, you can't mix this product with any other loans. You can't get a loan from Chase and then get this down payment or whatever it may be. I can't give you any other types of loans. It has to be combined with everything that has to be with CalHFA products. We'll go into that shortly. It also helps you with the closing costs. So we'll talk about that as well. And it's really focused for people that have moderate and low income. So if you're making over a certain dollar amount, which we're going to talk about in a minute, it disqualifies you from the program automatically. And it's in every county in California. The high level product overview is the down payments and the closing cost. In order to qualify, you're going to get a 20% down payment assistance. So as Anthony mentioned, so if you're buying, let's use a $500,000 purchase price of a condo. Let's just use that as an example throughout this process. You've got a client that's wanting to buy a $500,000 condo, and they don't have any money to put down. So CalHFA says, we're going to give you the $400,000 loan, and we're going to give you $100,000, which is 20% of the $500,000 as down payment assistance. You do not have to make payments on that $100,000. It just sits there at 0% interest, and you don't have to pay it back until will explain it to you in momentarily when you have to pay it back as well too. So it's just money that you're given in order to meet that requirement of putting down payment. In this case, it's great because they're giving you 20% down, which allows us to avoid things like mortgage insurance, which is expensive, and people don't like to talk about mortgage insurance. So as we talked about, bullet point number 2, you do not have to make any payments. It just sits there as a lien against your property, and you don't make any payments on it. It must be combined with the CalHFA first mortgage, which is, we're going to go over the rates in a moment, but the rates are fairly low considering the market currently. Today's market is somewhere around 6.125 is what the rates are at. So they're not like crazy interest rates. But the problem with this product is that we have to move quickly. There's only $300 million that's allocated for this product. And we started off with 700, did I say 300,000? I'm sorry, 300 million. So there was 700 million initially that was allocated to this product, but government decided that it was not appropriate to give that much money. So they brought it back, they brought it down to $300 million. So if it does well, it might come back with a larger dollar amount, but I think right now it's very important that you guys keep in mind that this product will be gone fairly quickly. So it's really important that you get in touch with your clients right away. Borrower eligibility, as we talked about, they have to be first-time home buyers. And we discussed what the first-time home buyer is. They have to be U.S. citizens, or they have to have a green card or permanent resident aliens. Must occupy the primary they must occupy this house as their primary residence. And it can't be for a second home and or an investment property. Sometimes this is a popular question, so I threw this in there, but you cannot have a non-occupying co-borrower help you qualify. So let's say if your mother or your parents are gonna just apply with you just to qualify, you cannot have that. So you have to qualify on your own merits. And the income cannot exceed in Los Angeles County, it cannot exceed $180,000 in Los Angeles, but there are other counties that have higher income limitations. And when we send this over to you, all of these lines are links that you could actually click on and see what counties your clients live in. And Orange County, for example, has a much higher limit for income than Los Angeles County, which is kind of shocking to me. Everybody has to go through a home education process. And this is one of the bigger obstacles that we're going to run into here shortly, because these home education classes are filling up very quickly. So if you have clients today that you're thinking that they should probably get signed up for this or apply for this product, I would highly recommend I would recommend you to send over maybe this presentation or these links on bullet point number 6. They would go on there and register and at least save a spot for them so they could get at least fulfill the education process. I'm hearing that they're already like 2 or 3 weeks out booked up. So I really would recommend for you guys to do that. This is the income limits. We've highlighted them for you. So as you can see on the first column, Los Angeles County is 180,000. But as you can see, Orange County is $235,000. And then furthermore, Ventura is 228. It's higher than LA County, which is interesting again. So this is basically saying that if you make more than $180,000 in Los Angeles, you cannot qualify for the product. So just make sure that you guys ask that question for your clients so that way they don't waste their time. I think it's a generous income limitation. I don't think it's a very low income limitation. So therefore, I don't think it's going to disqualify a lot of people. So I'm sure that this is a conversation for us to have because Los Angeles County, as we all know, we're very heavy on ADUs recently. And that's been a topic that we've been discussing for a while. And so let's get into it really quick. Single family and 1-unit residences are qualified. Condos are qualified. Manufactured homes are qualified. And leasehold estate properties are qualified. So there's properties in Palm Springs, for example, that are on leased land will qualify for this as well. 2 to 4 unit properties will not. So duplexes, triplexes, fourplexes will not qualify for the product. But what I wanted to let you guys know is I put a little bit more explanation in the middle over there for accessory dwelling units. That is allowable, and we could use the income from the ADU to qualify as well. So that is the only caveat for the multi-unit situation, where as long as the property is not considered 2 units on public records, you could do you could finance this property. So a lot of properties in LA have ADUs already, so it would probably help the person subsidize their payments. So that is a really, really great thing because previously we were not able to use ADU income to qualify. So loan amounts, I'm sure everybody's going to ask me that question later, like what's the max they could buy, right? So in Los Angeles County and Orange County, conforming loan limits, as you guys could see over here, it says $726,000 max conforming loan limit. Maximum high balance loan limit is $1,089,300. So technically, you could get a loan of up to $1,089,000 on the first mortgage, and then we'll give you the additional 20% down. So that would mean you're going to be somewhere around, what do we say here? $1,089,300. So about $1,360,000 as the purchase price. I feel like that's a fairly generous number as well too, to be able to qualify for this program, just because, I feel like a lot of people can find properties in the Valley or whatever it may be that are under the $1.3 million range. The only caveat with high balance loans are they have points that you have to pay. We all know what points are, but CalHFA makes you pay points to get those higher loan amounts, and they're listed in bullet point number 2. It's up to 1.379% points. These are all things that can be paid because they could finance all of these things, but they are part of the process of buying this or getting this loan at a higher loan limit. So If you have any questions on this, I know it's confusing. I'm giving you guys a lot of information right now. So, but write down the questions. I'm sure that's going to be a question that's going to come up a little bit later. So technically you could get up to $1,089,000 loan amount, but you have to pay points to get that loan. They all have to be impounded, very basic. They cannot not impound their property taxes and insurance. And the good part about this is that you don't have to pay anything back until you sell your home. So sell, refinance, or pay off, or transfer. Some people transfer properties, and that's going to trigger that loan to be paid off, because CalHFA is going to monitor that. So let's say if you transfer that property from your name to your child's name or someone else's name without, like, on title, that's going to trigger for you to pay that 28% off. And that's going to be, something that you don't want to do, obviously. So we'll advise you and educate you on that. And that's what the education and the counseling is for. So just wanted to let you guys know, I think that it was a very popular question that I've been having lately is, what do we do? When do we pay this off? Is you don't do anything with it. It stays live until you sell or refinance. Now, the good part about it is that they will allow you to refinance once if the interest rates drop, and don't take any cash out, and they will take that 20% and subordinate. I know that's a lot of information again, but a lot of these products don't allow to subordinate. When you go to refinance them, they say, no, you can't refinance, just pay us off, do what you need to do. But this particular product is great in a sense because it will allow you to refinance, because what we see is that rates are going to drop going ahead of us in the next few months. So if they get this loan now at a rate of 6.125 and rates drop to 5%, California doesn't want to impede in the person refinancing. So therefore, they're going to allow you to refinance once. You're not going to be able to refinance multiple times. Let's move on to the next. You guys are going to wonder what the qualifications are. The clients just need to have a credit score of 680 with like standard income. Most people are going to have a standard income. There's a caveat with CalHFA, this particular product, is they have a low income like carve outs for them, but a lot of people with low income are not going to qualify for these higher purchase prices. So I really don't want to go into that and confuse you guys any more than it already is. So let's focus on the minimum FICO score requirements. FICO score is going to be 680. The great part about Arcstone Financial too is that when your clients come to us and they apply for a mortgage, we're going to look at their credit scores and we're going to say, by the way, we could bump up your score by 5 points, 20 points, 30 points by doing certain things. So don't be afraid if the client says, I've got bad credit scores. We could do that over here within 3 or 4 days. So don't discourage them from applying. So 680 FICO score, they could go up to, 105 CLTV. I don't want to go too much into that. That means that we're going to finance the 100% of the house, and we're going to also be able to give you the closing costs as well. So that's something that we could do. And then some people, I don't know, this is a funny question that I get all the time. They go, what if I want to put 10% down? What if I want to put 20% down of my own money? Can I get that money still? Absolutely. As long as the combined loan to value ratio does not go below 70%. So let's say, for example, if the person wants to put 50% down of their own money, they could do that, and we'll still give them the additional 20%. So it'll be 70% combined loan to value ratio. It's a silly question, but oddly enough, someone's doing that that we know. So they're taking advantage of it. Moving on to the next. Another odd thing that you don't really run into, but this is a common practice, I think, in real estate that you all do anyway, is that home warranty. This particular loan type requires that the seller get a home warranty policy for the buyer, or the buyer could buy their own. So as long as there's a home warranty policy that is allocated to this transaction, so if you're writing an offer, just write in there that the home warranty policy needs to be part of the transaction. And it needs to cover the water heater, the air conditioner, the heating, and the oven, stove, and range. So it's obvious, it's a minimal coverage, I believe. When I spoke with some home warranty companies, they said that generally it covers all of these anyway. So it's not going to be an expensive home warranty policy. So I would think it's about somewhere like $600 to $700 that the seller would have to pay for, or worst case scenario, the buyer might have to pay for it themselves. This is the fun part, right? So this is the math part. So are you guys ready? So I'm going to send this over to you guys, but I'm going to really simplify it as much as I could without going into it as all the bullet points over here. Let's take a case example over here. We said the person is going to buy a $500,000 condo. They apply for this loan. We say, perfect, you qualify. We're going to give you a $400,000 first, and then we're going to give you a $100,000 second. That is part of the shared appreciation program. That second, that $100,000, you don't have to make payments on. It just sits there. Now, 3 years later, property is worth $700,000. And the person that, the family is growing, they want to move on to another home. You decide to sell this home at $700,000. So we have $200,000 of appreciation, and that's common. We've had that happen in the pandemic. A lot of homes became very expensive. I'm not sure if we're going to have that kind of level of appreciation going forward, but it's very possible, given the economic situation of not having enough inventory. So with that said, we have $200,000 of appreciation. CalHFA says, if we give you this money today, we are going to take 20% of your appreciation at the time of sale or transfer or whatever you do at that point, or refinance. But if you want to get rid of this entirely and you want to refinance and get rid of that second and get into a conventional loan, they say, great, wonderful, just give us that additional 20%. So do we know what that is? It's $40,000. They're going to want $40,000 of that $200,000 appreciation. So that's what you're giving up, but you're making $160,000 that you would have never been able to accumulate without having this down payment assistance program. So a lot of people say, well, why would I want to give a portion of my income away or my appreciation away? It's a vehicle that you don't have another opportunity to do with, obviously. So I think it's a great product in a sense, because if you don't have anything to put down, great, take it, give that 20% to CalHFA. There are a lot of other tiny little nuances, but I don't want to bug you with all those things. It's all in here. But the biggest piece of it is that you're only giving 20% of it away. Now, if your client qualifies for the low income limitations, you would only give 15% away. So as long as if the person is at the low income limitations, which I guarantee you guys, probably 98% of the people will not qualify for that in Southern California. But if there's that anomaly person, they would only give 15% of it away. I gave you guys an example. There's this other caveat that you're going to run into. You're going to say, well, Marty, what if they made $2 million on this? There was a $2 million appreciation. What happens? So the maximum CalHFA said is that they're going to get from this particular borrower is 2.5% of the amount they gave them. So I put an example on the right-hand side. I said, all right, well, if the person buys something for $500,000 and CalHFA gives them $100,000, the maximum that they could collect from that individual is 2.5 times the amount of that $100,000, which is $250,000 plus their down payment assistance. So altogether, $350,000 is what they could collect from them. So that's on the bottom over there. But realistically, to get to that point, that house would have had to have sold for $1.7 million. So the appreciation would have had to have gone up significantly. So this is a very rare time where you ever hit the top ceiling. But, I've seen it happen. In 2008, a lot of people bought homes for very cheap, and values came up much, much higher. So you never know what economic situations are up ahead of us. So it's good information for you to know that the maximum is going to be 2.5% or 2.5 times the down payment amount. I think wanted to at this point in time give you guys some basic FAQs that we've been asked. So I'll just read it off. Are borrowers required to make monthly payments on the shared appreciation loans? No, you're not. Can the shared appreciation loan be used to pay off borrower's debt? Nope, you cannot. That could only go towards the down payment. You cannot use it to qualify. Like you cannot say, oh, I want to use some of that money to pay down my credit card so I could qualify. You can't do that. It's just going towards your down payment. Can the borrower receive cash back from the shared appreciation loan? Nope. It's all going towards the down payment and it's going to stay there. There's no benefit to the buyer. You can't get cash out of it. Can I use non-traditional credit? This is another question that we get quite a bit because a lot of people confuse this product with FHA, because FHA allows you to use non-traditional credit, and this is not FHA, and it doesn't. Your credit score has to be established, and you have to show that you are able to make payments back. Do all borrowers need to meet the minimum credit score requirements for CalHFA conventional loan programs? Absolutely. If it's a husband and wife, they cannot, one of them cannot have a 620 credit score and the other one have 680 credit score. Both of them have to have a 680 credit score or above, obviously. I'm going to stop here before I go to the next section. And I know a lot of people have questions, so I'm going to stop here and answer as many questions as I can. Do you feel like that's a good time for us to do that, Anthony?
I think that would be good. So I know one question that was.
I'm sorry, I can't hear the question, but how should we manage this? Should we do it through chat? Should we do it through asking? How do you guys want to do this, Anthony?
He's muted.
Oops. Sorry, guys.
Okay, sorry about that. We have like, yeah, crazy system. So yeah, definitely let's answer some questions. Mark, yeah, if you want to maybe like pull up the chat on this so I could see some of the questions. But I know one of them was, so if there's a married couple, does their combined income have to be under 180,000 or each one, or how does that work?
It's combined income.
Combined. Okay, I think I saw a question from Stacy saying, is there any down payment you have to make? She heard there was a 1% down payment.
Nope.
Nothing.
So
even, you know, you were mentioning that you're getting that 20% down. If you want to put more down, you can, you know, to keep your payments lower. And you even have the opportunity maybe to have some of your closing costs paid for. So yeah, it's possible that you could come in with 0 down. Vacant land out of state, no, needs to be single family, needs to be some type of residence you're living in. What else do we have?
What if you own an income property?
Okay, if you own an income property but don't live in it and you're buying a house for yourself to live in, can you do that?
I missed that question. What was that again?
So if you own an income property but you're renting right now, can you purchase a home to live in and use this?
If you are, as long as you don't have a primary residence for the last 3 years, you're considered a first-time home buyer. So if you are, yeah, so if you have an investment property and you don't, yeah, so their definition, if I go back over here, a first-time home buyer was, first-time home buyer is defined as a borrower who has not had an ownership interest in any principal residence or resided in a home owned by a spouse during the past 3 years.
Okay. About the education, there was a whole bunch of links you have right here on this slide. You just can sign up for any one of those to get the credit for education. Is that right?
Correct. Yes. You have to do both. Yeah, there's 2 education, online. Yeah, I'm sorry. Yes. Any of those could be,
any of those.
Yes, could go towards your credit.
So it sounds like, you know, the first step, if anyone's on this call or any of your clients are interested, is find out one of those programs that maybe has the lowest wait time to get into a class and have them start that class. They can start the class before they even apply for a loan officially, right?
Yes.
Okay, so start with that. That's the next step. Go to one of these links. We'll send them out to everyone who's registered today with the Zoom. You'll get Marty's presentation and all of this, and sign up for a class. That's the first thing.
So yeah, I mean, as far as like, I'm sorry, go ahead.
A couple more questions. So what happens if you sell at a loss? Oh yeah, this was a good one I was thinking of. What happens then? You know, because we never know.
So, I mean, that's a short sale. Is that what you're talking about? So, I mean, a short sale is going to go through the process. Obviously, you don't have to pay back any appreciation.
Well, no, not even a short sale. Well, maybe is it a short sale? So say, you know, home values went down just 5%.
It's still a short sale because you financed 100% of it. If you bought the place for 500,000 and you're selling it for 470, 480, whatever it may be, you still owe the, you know, CalHFA the additional, because they give you the entire money. So it's a short sale.
Got it. Okay, that's a good question.
Because they're both liens, they're both loans. They're just, one of them doesn't require payment. That's the problem.
Okay, so they would have to negotiate like they would in any short sale situation with the lender to figure out what they're able to do.
Correct. And in this case, just so you guys know, the servicer of this product is a company called Lakeview. They are the servicer. I mean, there's a servicing company that's master servicer of CalHFA, but CalHFA ultimately makes all the decisions.
What day did it roll out? Because I felt like it was just being voted on. Yeah, what day did this roll out? It started like just over a week ago.
March 27th.
March 27th. So we're in right at the beginning. And honestly, I've heard so much buzz about this, and I know people have already been applying. It is not going to last long. This is definitely something that, you know, if you're on the fence, at least start with these classes and explore it. You're not committed to buying a house. You're just starting that process to find out if you that looks like and if you can qualify. So I think, yeah, it's something that needs to happen soon.
I mean, I anticipate it to be about like 2,500 to 2,800 transactions. So it's not much if you're doing that all throughout California. Maybe like 3,000 because some areas are much cheaper. But if a concentration of Los Angeles comes in, or Orange County or Ventura County comes in, it's probably not going to be more than 3,000 transactions. So really, truly, it's a very imperative thing that your clients should get on it right away.
So how about this situation? We have two roommates that are renting right now and they want to purchase a property together. Can they do that?
They could, yeah, as long as they're both on the, they're both qualifying with the income and they both don't exceed $180,000 combined income. And they also, yeah, and their credit scores are at 680 or above.
Great. So once qualified, you're ready for a loan. Is there a timeline that has to happen to make a purchase? Or it's just, I don't know. How are they going to tell us that funds are out? I guess once funds are out, it'll be on the news.
That's the question I've been asking CalHFA. I've asked them to see if they could put it on their website so we could track it because we have direct communication with them. That's something that they're probably going to work on. I mean, I'm hoping it's not gone before I put it on their website. So
yeah, give us a warning.
Yeah. So I'm trying to get that data. There's buzz that maybe about 1 million is already gone. I feel like, so that's the buzz that I've heard so far. But I just wanted to, I don't have that as a factual information. So I wouldn't go off of that information, guys. Like, I don't think that's valid. That would be too crazy if $1 million is gone already within a week's process. So, but you never know. I mean, I'm sorry, 100 million, not 1 million, 100 million.
What is considered low income? What's the highest salary you can have
so I believe the low income is let's take a look at that. I believe that was
for LA
5,000 Nune, or was it 65?
60 I believe it was 66,000.
66,000, which is not a it's not going to get you much.
No, it's going to get you in about a $250,000 home.
Okay. That's definitely good to know. Is there any other new questions we're seeing?
I think,
Oh,
I'm
Go
sorry,
ahead, Marty. Go ahead.
No, I just, what I was gonna say is that, you know, to jog your, like a lot of, even a lot of realtors have reached out to me and they've said, can I buy a home on this? Can I qualify? I mean, it's an opportunity for everybody to buy, or even I've been telling people in our office to get on it and buy a home, because it's like 20% given away for someone to be able to make potentially, as we all know, in Southern California, we like, it's hard to save $100,000-$200,000. I mean, I have an ex-employee that bought something a couple of 2018, and they bought it for 400,000, and it's now worth $700,000. I mean, that's like so hard to save that much money, but yet, you know,
Yeah.
you guys know all this story. I don't have to say it, but it's just something so plain and easy that people don't see sometimes, that, and then they get caught up with the shared appreciation, which makes no sense. It's like, would you rather have something of nothing or or something of like, you know, it just makes no sense
Yeah.
not to keep some of it
So
away.
one other question. If someone puts in money to do improvements, say $50,000, are they able to deduct that from the amount that the property went up, or it's just based off of sales price?
Just based off of sales price.
Yeah.
So there's no deductions that you could do off of your taxes, obviously, but you know, I mean, but if it's your primary residence, never mind. I take that back. You can't deduct that off of your taxes. I don't want to give you guys tax advice.
Okay. Someone mentioned some of the online classes, they might cost money, $99. Do you know anything about that?
It is,
How much
yeah.
they do? Okay.
I believe, I don't have the exact amount, but there is a cost. I believe it's up to $250.
Okay. If anyone has any other more detailed questions, please reach out to Marty. I know that we didn't get to every question, but some of them were pretty niche and some of them were already covered in the slides. So we'll send out these slides to everyone who's registered so you can review this and reach out to Marty with any of your clients or yourself if you're interested.
Can I answer one of the questions over here? It says which FICO specifically. There's no, we take the middle FICO score. So it's not a particular TransUnion or an Experian credit score. It's the middle FICO score. So you drop the highest, you drop the lowest, and you go with the middle credit score.
Great. And the interest rate is set for this program. It's on their website. Today it's at 6.125, Marty said, but that fluctuates day by day. So depending on when you lock that in, it may be a little different than that.
Well, actually, my apologies. They just
It's
published it
6.
today. They dropped it down to 6%.
Oh, okay. I think last time we talked, it was 6.3. So
Yeah.
that's good. Very good news, from 6 to 6.3.
Well,
Okay.
if you guys have been also looking at the markets, I mean, where the rates are like dropping significantly the last couple of days, because we're finally seeing some movement on the jobs reports, where they feel like the numbers of unemployment are going up. So the markets are reacting favorably to that. So that means that whatever the government's been doing is, you know, actually paying off. So with that said, yeah, so rates are, I feel like they're, you know, going down the last couple of days. So it's a good time for people to get locked in for these products as well too.
Great news.
More clarification. So there's no interest being paid on the 20%.
Yes, correct. There's no interest being paid on the 20%.
Nope, 0%.
I mean, the great thing about that is you have a lower mortgage payment because of that. Right. You know, and so you're not paying the mortgage and interest on that. You're just paying the appreciation when you sell. Like, and you don't have mortgage insurance. I mean, come on, this is amazing. This is gonna help so many people. Well, it's gonna help 3,000 people. Yeah. Hopefully it will be more. I mean, as you know, like I lobby, I'm going to be in Sacramento for a week in May lobbying with our legislators. And I guarantee you this program is going to be one of the hot topics that we talk about, that it's something that we'll be asking to have extended and more money.
The 20% that you pay back when you sell goes back to funding the program.
Oh, it does.
Yeah.
Well, okay.
When you make that 20%, when you make a profit of whatever 100,000 and you're paying 20%, that 20% goes back to this program.
I don't know.
Yeah,
That's what it says. Okay, so then maybe the intention is to keep the program
going.
going, but there may be a break, right? So after these first 3,000 is done, we might not see this program again for another year or two, or who knows how long. So yeah.
I think we're gonna see if there's performance on this. If it performs well, you'll probably see it come back. This is a profitable product for the the state. And so it would definitely sustain as long as people are going to make their payments and people don't default on these products. I don't think that this is going to go away permanently. I think if this performs well, we'll see more of this, and it would be really helpful because this makes homeownership possible. The other thing is that, as far as like the product goes, it just makes it where, people are just going to end up having to, perhaps I guess what I'm trying to say is that, the state is not going to get into this product if they don't feel that the appreciation is going to continue. So I feel like, they're not, if they, they have smart analysts that work for them, they're not going to get into this program and give you 20% if they feel like the values are going to drop. So it's a good indicator that the state is putting their money out as well, saying that, we think that the appreciation is going to continue down the line. We don't think that the values are going to drop.
And I think that's a great point, right? Because we were talking about that this morning, that some of our buyers are on the fence because they think, should we wait longer because prices may go down? Well, the state's betting on it that they're not going to. All of our economists are pretty much saying the same thing too. So this is just another talking point that we have as a realtor to help people understand that prices aren't going to be coming down a lot. And if they do, it's going to be very, very little short term, and they're going to move quickly back up. So thank you for that. Mardi, thank you so much. Thank you for everyone for attending. We're not quite done yet. Mardi has a few other programs to talk about as well.